This is our Forex blog for May 8th, 2013, and this is our currency index, which basically takes each currency and compares it to all the other ones. In this case, the dollar index is made up of the euro dollar, pound dollar, dollar Swiss, dollar CAD, Australian dollar, New Zealand dollar. I'm not sure if I mentioned dollar Swiss. The euro compares every euro pair, and we actually created a chart. And you can see the previous day's high of the dollar index, the previous day's low, which tend to act as support resistance. You can see the euro had a hard time getting above yesterday's high in the euro, but once it broke above, it then became support, just like a normal chart. We also have the hourly moving average in the middle. The green line is the 15-minute moving average. The yellow line is the average price, the price most traded in all the dollar pairs, which tends to be a great support resistance area. And once certain areas get broken, it tends to cause continuation moves. When the euro broke above the previous day's high, it's likely to continue trending up. Same thing here with the Swiss. When a currency breaks down through the point of control, most of the time that trend's going to continue. You can see in this case it didn't, but the trend did last for 30 minutes, giving you opportunity to profit. So basically, in a nutshell, you want to buy the strongest ones versus the weak and sell the weakest versus the strong. Underneath that, we have the daily trend and the weekly trend. Now, if a currency is stuck between two areas of resistance above and support below, it's likely to be choppy. The point of control and the hourly moving average, when the price is in between there, it tends to go up and down, up and down. So not only can this help you find very high probability trades to be in, it can also help you, for lack of a better term, save your ass by not getting chopped up in a very likely choppy period. Now, if the distance is significant enough away, you can certainly consider trading in these. But the tighter the range, and when you see it going up and down, you just want to avoid it and wait for a breakout. Once it does break out, you're likely to have a profitable trade. You can look for double tops, double bottoms. You can see the Australian, pretty much last night's high, today's high, today's high. The hourly moving average is stuck in between that area, and when it breaks this trend line here, you have a multi-hour downtrend. And in 8:30, you basically want to trade it against whatever currency is the strongest, and that would be the euro. The euro is the only one at 8:30 that's above its previous day's high. It broke out. It acted as resistance. There was some selling there. Once it broke above, people who were short the most euro pairs from yesterday and earlier today, they're all losing money. And so that's the benefit of using this tool. When you know that the majority of traders who are short are losing money, at some point they're going to have to come in and cover their positions, and that's going to add fuel to another up move. So let's take a look at buying the strong euro versus one of the weakest ones, the Australian here at 8:30. You're going to probably find when you have those two currencies making the same big moves in opposite directions, 30 to 50 pip moves. So here's the actual chart. At 8 o'clock, you can see a little bit earlier in the day it broke from below to above the hourly, went up to our upper containment band. Notice the perfect oscillator, anytime this hits plus 80, typically that's going to be a place where price will either go sideways or reverse. Went sideways here and reversed here. You can see the exact opposite here. It came down really close to the minus 80 level, right at 7. And this is telling you it's likely to go up. And the trend was up at that point. So anytime you see a big move up followed by a pullback where the perfect oscillator is near the minus 80, it's a pretty high probability. You have a nice little hour and a half sideways rectangle, and it broke out at 8:30. And you can see it went from 28.80 all the way up to 29.45. 65 pip move, pretty much straight up, and very easily identified with our currency meter. Our currency indexes. Now you can also, if you want, use our currency meter technology on this. And so you can see the currency index chart. You can see any of our statistical tools and see how strong or weak it is. With the FX trend intensity, normally plus 80 level trends tend to continue. And anytime you see moves up with a lot of strength, followed by pullbacks with very little weakness. This is a very high probability place to buy, this little sideways rectangle breakout, and you can see, you know, diminishing weakness right there. You might have went long here around 8 in anticipation of a big move up, which happened. And you can see the daily, weekly, and monthly trend is all up. So the real-time trend's up. Our statistical tools are showing you it's going up with incredible force. And the daily, weekly, monthly trend's up. All the trends of the euro are up. It's above and it's stronger than the strongest it was yesterday at 6. And it pretty much stayed that way for many hours. And what if you want to do counter trend trades? Well, there's a lot of ways to do that. I took some trend trades in the euro dollar pair today, but I also probably made close to 30 pips doing counter trend trades as well. You can very highly predict by drawing your fibs off the last wave, you know, areas it's going to reverse. And when it's above the Bollinger Band of this, you can see at 10 o'clock, pretty high probability place to be selling the euro. And so let's say it's easy to show how to use this for trend trading, but I'm going to try to show how to do some counter trend trading. Here's a euro dollar at 10. You also want to draw the fibs off of this chart as well. And you can see at 10 o'clock right here, it's kind of forming a little double top over the last hour and a half. It's at the 1.382 fib target. It's above our 2.0 white band, and the previous move up had incredible perfect oscillator over 80 readings. And usually if you see a double top, double bottom with less momentum at the second peak, there is just not very much real-time momentum pushing this up. And you can see it fell from around 75 downward. A lot of times I scale into trades, and you know, I got, I think, into this trade pretty lightly around 55. I think I added to my position at 65. I put on a big position here, and I got out of the first one on a little pullback right here. Then I went in with a smaller position here and made about 15 pips on that one. And I got into a little bit bigger position in the second trade up here. And when I see it going up, a lot of times I'll get in, let's just say for illustrative purposes, say with one lot here. It starts to go back up a little bit. I'll either add 1 or 2 lots, and as soon as it comes down, I usually will add a significant more positions to try to get my average position as close as possible to the high. And that way, even if it pulls back a measly 10 pips with a big position of 10 to 15 full standard lots on it, you can make really good money doing counter trend pullbacks. Usually it's only a matter of time before pullbacks happen, especially when you get a move above the white band and you have a perfect oscillator, which uses completely different data. They both use statistical tools that we have, but they're both totally different from each other. So anytime you get a perfect oscillator of a plus 80 and also prices above the upper band, it's much higher probability for counter trend. So I will try to showcase one more method for predictive type of trading, and we'll look at trend trading. Here, the dollar earlier was trending down. It broke the previous or the point of control, and it went sideways here for many hours. Couldn't get it back above it. As soon as it starts breaking down here at 10:45, it's very high probability. You want to sell the dollar versus the euro, which was very strong. The Swiss was very strong. The pound at that time is very strong. So around 10:40, you want to be looking for euro dollar buys. Here's 10:40, and you just got a nice little pullback right here. Sorry, that's not what I meant to do. Nice little pullback right here. And I prefer it when I get a pullback where the perfect oscillator is at the Bollinger Bands around the perfect oscillator, like something like this or this. Those tend to be really nice scalping type trades, as you can see. But here is 10:30, you have a nice little pullback, and you know, as it goes up and it shoots over the perfect oscillator's Bollinger Band, it's right near the 1.618. That's a good place to get out of that trade. Quick little 20 pips in about 20 minutes with a very tight stop. Anytime you risk this much and you have a good high probability chance of making that much, you got to pull the trigger. So let's take a look at the pound dollar, which also was an excellent one around 10:30. This one's just kind of going a little bit sideways. You might have got into this trade a little bit earlier. I don't like to buy breakouts above the 2.0 band, although the perfect oscillator at the time did not show an extreme reading as far as the plus 80. It does have potential room to go. And your profit target on this is the Fibonacci profit target of the last move. Typically, if it's very strong, it'll go to the 1.618 and sometimes a little bit above it. Anytime this is above the plus 80 level, you just kind of want to keep moving your stop up underneath each bar's low. And so you'd be out somewhere on that bar right here when it broke down underneath the previous bar's low. Because it's only a matter of time when that's going to reverse. Now here's a minus 80 reading. However, the price is still above the 2.0 band, so you don't want to be looking to buy when the price is above the band. This is exactly why I have a really hard time buying above the upper band, because most of the time the trade's not going to work. So this trade right here is a much better little mini pullback where you can have a super tight stop, and even if it goes back up to the high or the band, you have a good chance of making more than what your risk is. That's the key to trading. Small losses, bigger wins.